What if I told you the stock market doesn't crash because the world ends? It crashes because people get scared at the same time. Not evil, not dramatic, just human. Let's make this simple. Imagine you live in Chicago, or Manchester, or Berlin. You're 29. You make $70,000 a year. After taxes, that's roughly $4,200 per month in your bank account. Your rent is $1,800. Car payment, $450. Insurance, $200. Groceries, $500. Student loan, $300. Subscriptions, phone, utilities, $400. Eating out, small trips, social life, $400. You're left with maybe $150 to $200. You're not reckless, you're not irresponsible, you're just normal. And like most normal people, you've heard that investing in the stock market is how you build wealth. So you open an app, you invest $300 per month, maybe into an index fund, maybe into a few trending stocks. At first, it feels smart, adult, responsible. Then one day, the market drops 10%, then 20%, then 30%. Your $15,000 portfolio becomes $10,500. Nothing about your job changed, nothing about your apartment changed. The companies you invested in are still selling products, but your screen is red. And this is where crashes actually happen. Let's explain it like you're 5. Imagine a neighborhood where houses usually sell for $300,000. One day, someone sells their house for $270,000 because they're nervous about the economy. Now everyone thinks, wait, are houses only worth $270,000? So someone else panics and sells it to $50,000. Suddenly, every house is worth less. Did the houses physically shrink? No. Did the bricks disappear? No. The price changed because people changed their expectations. A stock is just a tiny piece of a business. If investors believe that business will earn less money in the future, they're willing to pay less today. When millions of investors feel uncertain at the same time about inflation, interest rates, layoffs, war, housing, they all try to sell. More sellers than buyers equals falling prices. That's a crash. Now here's the uncomfortable part. The market doesn't just expose companies, it exposes people. Remember your monthly budget? You only had $150 left. So when your investments drop by $4,500, it doesn't feel theoretical. It feels like, that's my rent for 2 months. That's my emergency fund. That's my safety. And this is the hidden system flaw. Most middle-class investors are investing with short-term money, but long-term expectations. They say they're investing for 20 years, but emotionally they're checking every week. Psychologically, this creates tension because your life is expensive. When 80% of your income goes to fixed costs, volatility feels dangerous. Now let's use simple math. If you invest $300 per month for 10 years at an average 8% return, you could have around $55,000. But if you panic during a crash and sell after a 30% drop, you lock in losses. Then you wait. You feel cautious. You re-enter later when things feel safe, usually after prices have already recovered. Missing just the 10 best recovery days in a decade can dramatically reduce long-term return, not because you're unintelligent, but because you're human. Here's the psychology. Humans hate losses more than they enjoy gain. Losing $5,000 hurts about twice as much as gaining $5,000 feels good. So when markets crash, your brain doesn't think about 2035. It thinks about survival, and survival thinking is short-term. Financially intelligent people understand something simple. The market is not a straight line. It's a cycle. Boom, confidence, euphoria, fear, panic, recovery, repeat. They don't assume crashes are rare accidents. They assume crashes are part of the design. Instead of investing money they might need next year, they separate time horizon. Emergency money stays safe. Long-term money accepts volatility. They don't interpret falling prices as the system is broken. They interpret it as expectations are resetting. Because a crash is not the destruction of value. It's the repricing of future optimism. And over long enough periods, 15, 20, 30 years, productive economies tend to grow, not smoothly, but persistently. The tragedy isn't that markets crash. The tragedy is that many middle-income earners are forced into short-term thinking because their margins are too thin. High rent, high debt, high fixed expenses. The real risk isn't volatility, it's fragility. If your financial life has no breathing room, every downturn feels catastrophic. If it has margin, downturns feel uncomfortable, but manageable. So the stock market crash, explained simply, is this. It's not the world ending. It's millions of people reacting emotionally to uncertainty at the same time. And whether it harms you long-term depends less on timing and more on structure. Structure of your expenses, structure of your debt, structure of your expectations. Crashes don't create financial weakness. They reveal it. And if you understand that calmly, without panic, without hype, you start to see the market differently, not as a casino, not as a guaranteed machine, but as a reflection of collective human behavior. If this helped you see crashes more clearly, consider subscribing.